Apartment investors have several exit strategy options, each with unique advantages and considerations. Choosing the right exit strategy involves assessing factors like tax implications, transaction costs, timing, and alignment with investment goals. Common exit strategies include outright sale, refinancing, 1031 exchanges, partnership buyouts, and property conversion. By understanding the pros and cons of each option, investors can make informed decisions that maximize returns and support their financial objectives. Advantages. Selling the property provides a clean exit and complete liquidity, allowing investors to access all the equity built up in the property. This is often ideal for those seeking to cash out or invest in other ventures. Disadvantages. An outright sale triggers capital gains tax and depreciation recapture, which can significantly impact net proceeds. Transaction costs, including agent fees and closing costs, also reduce profits. Timing considerations. A favorable market with high demand can maximize returns on a sale. However, a downturn in the market can reduce profitability. Example, selling outright in a strong market allows investors to capture appreciation but may result in significant tax liabilities. Advantages. Refinancing provides access to the property's equity without selling, allowing investors to retain ownership and benefit from ongoing cash flow. This strategy is useful for raising funds for other investments or property improvements. Disadvantages. Refinancing incurs closing costs and may result in higher monthly payments if interest rates increase. Refinancing may also increase debt, impacting cash flow. Timing considerations. Refinancing is often beneficial in a low interest rates environment or when property value has appreciated, providing more equity to tap into. For example, refinancing a property with substantial appreciation allows investors to extract equity for additional investments without triggering capital gains tax. Advantages. A 1031 exchange defers capital gains tax by allowing investors to reinvest proceeds from the sale into a like-kind property, preserving capital for growth and portfolio expansion. On the flip side, disadvantages include the need for strict adherence to IRS timelines. 45 days for identification and 180 days for completion, which can limit property options. Additionally, transaction costs, like intermediary fees, apply. Timing considerations. A 1031 exchange is beneficial in a high-demand market where property values are high, maximizing the amount reinvested. For example, an investor selling a property with significant gains uses a 1031 exchange to defer taxes and upgrade to a larger, more lucrative asset. Advantages. A buyout allows one partner to exit while the remaining partners retain ownership. This strategy preserves the investment without selling the property, providing flexibility for both exiting and continuing investors. Disadvantages. Buyouts can be complex, requiring valuation and negotiation, and may lead to capital gains tax for the selling partner. Funding a buyout can strain cash flow for the remaining partners. Timing considerations. Buyouts are suitable when only one or some partners want to exit, or when the property still has potential for appreciation or income growth. Example, a partner looking to exit can be bought out by others, allowing them to realize gains without a full property sale, while the remaining partners continue to benefit from ownership. Advantages. Converting a property to a different use, for example, converting an apartment building to condominiums can increase property value and offer new income streams. Conversion may appeal to investors looking to capitalize on market trends or target new tenant demographics. Disadvantages. Property conversion requires investment in renovations, planning, and regulatory compliance, which can be costly and time-intensive. Timing considerations. Conversions are advantageous in markets with high demand for the new property type or when rental income from the current use is declining. Example, an investor converts an apartment building into condos to sell individual units, capturing higher value per unit than renting as apartments.